Welcome back to the channel, everyone. Today I want to talk about how Ken Griffin not only controls everyone, but quite literally controls everything to do with the US markets. So stay tuned and let's make some money. And now I want to dive straight in with the key information. So, this user on Reddit has picked up a few things from Citadel's recent exemption filing. It says a managing member, a member or Citadel entity that is registered as an investment advisor under the Advisors Act may be paid a performance fee or allocated a performance allocation, only if permitted by Rule 205-3 under the Advisors Act. It says to the extent permitted by the managing member, an eligible employee and or its qualified participant may be issued additional interests, whether vested or unvested, and or make additional capital contributions to the ESC fund in which it invested after such eligible employee's employment with Citadel has terminated. Unvested interest issued to an eligible employee after his or her employment with Citadel will typically vest following compliance with any post-employment conditions. And the poster says, so wait, that means that any Citadel employee, past, present or future, can still contribute to the funds and can still be paid a performance fee or a performance allocation. And their exemption from this act allows Citadel not to disclose any of this, not to disclose who's being paid, and not to disclose who's investing in the Citadel funds because they don't have to keep records. That basically means that even if Ken Griffin hires somebody and they leave or they quit, even if they never worked for Ken directly because they're part of a committee, or maybe they invested with Ken, or maybe for some reason Ken considers them a member or a Citadel entity or a qualified participant, that means they can still be paid by Ken Griffin with no reason and with no records. Even if that past employee goes to the DTCC, or they go to the SEC, or they go to a different government agency or any other fund on Wall Street, they can still be paid directly by Ken Griffin with no records. That basically means that anybody can still do some favours for Ken Griffin and he'll just allocate them a performance allocation or allocate them a performance fee, aka bribe, and nobody will know because Ken Griffin doesn't have to disclose it. And he said essentially that ties into past due diligence about Citadel employees leaving to work at the Boston Consulting Group, leaving to work at PwC or some major top accountants and auditors, or even directly going to work at the DTCC or other organisations like the SEC. Now, in many of my previous videos, I've spoken about how multiple employees from Citadel went on to work at the Boston Consulting Group and then infiltrated companies like Netflix, like GameStop, like AMC, and many others. But not only have these Citadel employees left to join the Boston Consulting Group, I'm sure there's many Citadel employees that have also left to join the DTCC, the SEC, or maybe even some top accounting firms. And he said everybody that worked at Citadel at any time in the past and potentially present and or future and now works for another company could theoretically and legally still be on Citadel's payroll. He says government agencies, clearinghouse approvers, auditors and the SEC all can still be getting money under the table according to this rule and according to this exemption. And he said that theoretically does include Dave Lauer, who is supposedly for the retail investors and is supposedly trying to force a ban on payment for order flow. And Citadel's exemption disclosure even states the company intends to continue to form and operate the ESC funds to provide long-term financial incentives for eligible employees or ex-employees of Citadel to preserve Citadel's competitive advantage and to align the financial interests of eligible past employees with those of Citadel and investors in the Citadel third-party funds. So that basically means that under this exemption, Citadel can continue to pay ex-employees to ensure that those ex-employees' financial interests align with Citadel's. It says Citadel has in the past and may in the future sponsor and manage other investment vehicles for the benefit of certain current and former employees and other affiliated persons that rely on other exemptions from the 1940 Act. Also guys, if you didn't already know, Moomoo do not accept payment for order flow because they don't clear through clearinghouses like Apex Clearing, who are obviously used by brokers like Robinhood and Webull. Instead, they have their very own clearinghouse, Futu Incorporated, and therefore they do not accept payment for order flow. Therefore, Moomoo is brilliant for buying those AMC shares. And right now, if you sign up to Moomoo using the link in the description below, you can currently get 5 free stocks worth up to $2,500 each and a free share of Lucid Motors on top of that. And he says, think logically. If you knew that you were losing and you saw that you were in a losing battle, if you saw that everything was about to come crashing down around you, would it be such a stretch to imagine that you could use a former employee who is still technically on the payroll to advocate for you to effectively buy you time or help you try and escape from a sketchy short position? And he said that Citadel have actually filed this application for exemption every single year since 2009, which seems to be about the time that Ken Griffin actually changed his mind on payment for order flow. Obviously, back in the early 2000s, Ken Griffin was actually against payment for order flow, but obviously sometime since the early 2000s and now, he seems to have changed his tune and now obviously loves payment for order flow. I think Ken Griffin was obviously corrupted somewhere along those lines, and since early 2009, every single year has been filing this exemption, so he doesn't have to disclose who's in these ESC funds, or he doesn't have to disclose who he still pays that used to work at Citadel. And therefore, it wouldn't surprise me if ex-Citadel employees have actually infiltrated the SEC and they're still being paid by Ken Griffin to effectively do his dirty work. But I also wanted to talk about the cost to borrow rate for AMC and how it's been absolutely skyrocketing over the last week or two. Obviously, in my previous few videos, I've shown you screenshots from Ortex that shows this rising cost to borrow rate, but I wanted to show you it in a graph format to show you how this cost to borrow rate stacks up against last year's rates. This data from iBorrowDesk only goes back to the 10th of June 2021, aka after the second run-up, but we can see that since the 10th of June 2021, the cost to borrow rate is nowhere as high or has never been anywhere near as high its current rate. The highest we've previously seen the average cost to borrow rate was back in August of 2021, where it briefly jumped to 6% for a singular day, but right now it's obviously holding around this 25% rate. If we rewind even further and find some screenshots from June, May and April 2021, we can see the current cost to borrow rate is very similarly tracking the May run-up. Back in April, the cost to borrow rate briefly shot up to 26% before falling slightly to 17%. It then shot up on May 12th, which is I think around the day we broke through that 801 barrier, all the way up to 89%. After we broke through 801, it did then fall back down to around 22% for the remainder of May until we broke through that $14 barrier, where it jumped back up to 22%. And obviously during the June run-up on the 3rd of June, the cost to borrow rate was around 19%. Therefore, seeing the current cost to borrow rate already hitting around 25% is a very promising sign, and I expect this to continue running upwards, maybe even high as 89% again, before AMC starts on the next run-up, potentially causing the squeeze. Personally watching this cost to borrow rate with a keen eye, as I do think it is a very, very important metric that shows that the hedgies are absolutely losing control. And Unusual Whales has also tweeted saying the White House says it expects the inflation numbers that are released at the end of the week, aka tomorrow, to be elevated. You'll remember that inflation previously fell from around 8.6% down to around 8.3%, but now the White House is expecting the CPI reading to again be elevated. I wonder if inflation is going to run back above 8.6% or potentially run even above 9%. This goes to show the Fed's current plan of hiking rates at 0.5% at each interval is still not satisfactory to curb inflation. Rates have obviously been pushed back up recently by 0.5%, but yet inflation is still running even higher and is again expected to be elevated. This goes to show the Fed is going to have to try and push interest rates even higher, even faster, potentially, obviously, crashing the economy. As I've said before, it seems like everything seems to be coming to plan for the AMC squeeze. Obviously, the cost to borrow rate is skyrocketing, and the market looks like it's going to be set to resume its crash tomorrow morning. On top of that, Unusual Whales has also tweeted saying Interactive Brokers founder and CEO Thomas Petterfy sees the stock market dropping by another 15%. Obviously, the S&P 500 recently bounced back a little bit after being down 20%, but even Thomas Petterfy still thinks the S&P 500 has another 15% to fall on top of that initial 20%. And therefore the market is still expected to continue crashing, which is obviously going to cause more and more and more stress to all of those hedge funds out there that are currently massively over leveraged. This Bloomberg article says the firm borrowed money to buy stakes in private companies and posted massive gains, but as those valuations fade, such bullishness is veered into losses across the industry. With the help of JP Morgan in August of 2020, D1 Capital Partners used its stakes in private companies as collateral for borrowing $2 billion that the firm could put towards yet more investments in more private companies. D1 updated its valuations on those private companies and posted a whopping 70% gain. Obviously for listed companies, the valuation is updated every second as the stock moves, but with private companies, valuations are typically only done on a yearly basis, not on a secondly basis. But now obviously as the market's fallen dramatically, the industry is bracing for a reckoning as they start to mark their private investments accurately for the first time in 2022. It says across Wall Street, billionaire investors and their advisors are urgently trying to figure out just how much exposure they have to plunging valuations in Silicon Valley unicorns and other private ventures. They're reviewing disclosures by some of the most active buyers of those assets, including D1 and obviously Tiger Global Management and many others. Valuations of many of these companies are now tumbling, which is only going to reduce the available margin that these hedge funds have to meet their margin requirements. Obviously, it's all well and good recognizing a 70% profit on your private investments to meet those margin calls and to meet those margin requirements. But what happens when you have to mark those private investments accurately and basically lose that 70% profit, losing massive chunks of margin? This obviously doesn't just impact funds like D1 and Tiger Global Management, it impacts many other funds that invest in private companies, like Citadel, for example. It says that's left hedge fund investors trying to figure out whether their money managers might suspend withdrawals, face demands from lenders to post more collateral, or, in a worst case scenario, have to start selling investments quickly enough to drive down asset prices in a chain reaction. Many of these private companies are now taking haircuts ranging from between 20 and 60%, and this is impacting on these hedge funds' available margin as more and more of these private investments are downgraded massively. Obviously, this is only going to add to the crashing market and exacerbate the effect of the current market crash. So guys, be sure to let me know what you think down in the comments below, and also be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.